Okay, so let's be honest, right? Trying to figure out digital finance, it can feel a bit like you're lost in a maze sometimes, especially when you're handing over your money, your own money, to someone else to manage. That big question always pops up. Are they really on my side?
Yeah, it's a huge question. And, that trust issue is kind of fundamental. But what if there was a different approach, a model that actually connects their success directly to yours?
Exactly. And that's what we're really digging into today, isn't it? This idea of transparent profit sharing, specifically in managed trading.
That's right. We're looking at some material from Faida Ventures LTD, and they're talking about this shift towards something more fair, more aligned between you, the investor, and the people managing your funds. It's a different way of thinking about the whole relationship.
It really is. So, our plan for this deep dive, for you listening, is to sort of unpack what makes this model tick. We'll look at aligned interests. What does that actually mean day to day? Why is this high watermark idea so important for fairness? Also, getting rid of those nasty hidden fees. How does that build trust? And maybe most interestingly, how is this stuff becoming, available to regular investors now?
Yeah, accessible, not just for the big players.
Right. The aim here is to give you a clearer picture, hopefully make things less confusing, maybe even a bit more empowering when you look at managed investments.
Okay, so let's jump right in. The core concept, aligned interests. Think about the traditional way. Often, managers charge fixed fees, right? Usually just a percentage of the total money they handle.
Right, like a management fee. So they get paid whether my investments go up, down, or sideways.
Pretty much. I
Yeah.
mean, their pay isn't directly tied necessarily to how well your specific portfolio performs. It's based on the assets under management.
Okay. So how does profit sharing flip that script?
Well, with profit sharing, it's simple, really. Their income, their fees are directly linked to your success. They only make money, only get those fees when your investments actually make a profit. It creates this very direct connection.
That makes intuitive sense. Their win depends on my win.
Exactly. And it's not just about chasing any old return. This is where it gets interesting. Based on the Faida Ventures material, this alignment tends to push managers towards focusing on sustainable risk-adjusted returns.
Sustainable, risk adjusted. Okay, what does that mean for me practically?
It means aiming for steady growth, over the long haul. Managing the risks carefully, not just going for broke on high-risk trades that might flame out.
So less gambling, more strategy focused on keeping my capital safe, but also growing it steadily.
Precisely. And that focus becomes even more critical when markets get choppy, volatile times. The main job becomes protecting and growing your money, not just racking up trades. Like the source says, if the client profits, both sides win.
Yeah, that both sides win idea feels much more like a partnership, not a situation where one side might do okay even if the other doesn't. It feels healthier.
It fosters collaboration, trust. It's performance-based.
Okay, so that alignment piece is clear. But you mentioned something earlier, high watermark. That sounds technical, but important for fairness.
Oh, it's absolutely crucial, yeah.
Yeah.
The high water mark is like a safety net for you, the investor, in these profit-sharing deals. Think of it as the peak value your portfolio has reached. The manager can only start taking their share of the profits after your portfolio value goes above that previous peak.
Okay, walk me through that example again. Let's say my account hits $10,000, peak value. Then, market dips, it drops to $9,000. Then things recover, it climbs back up, and hits $10,500. Where does the profit share calculation start?
Right. So in that scenario, the $10,000 is your high water mark. The dip to $9,000 doesn't matter for fees. The recovery back to $10,000 also doesn't trigger fees. The manager only gets a share of the profit on that $500 gain, the part that takes you above the old peak of $10,000.
Ah, okay, so they don't get paid just for making back lost ground.
Exactly. That's the key.
They have to generate new value, real growth beyond where it was before. That makes a huge difference.
It really does. It prevents you from being charged for essentially recovering losses. It ensures fees are only tied to genuine new profits. Makes the whole thing transparent and, well, fair.
No arguments there. It feels like a basic fairness principle, honestly. You only pay for actual new gains.
Right. It builds that equitable structure the source talks about, less
Yeah.
risk of overcharging, fees linked directly to, actual wealth creation.
Okay, that leads nicely into the next point, which I think worries a lot of people. Hidden fees.
Ah, yes, the bane of many financial agreements.
You know those little charges buried in the small print that just chip away at your returns? How does this transparent model tackle that?
Well, the name kind of gives it away. Transparency. The whole point of these models is absolute clarity.
Yeah.
You know upfront exactly when fees are charged, how they're calculated, and what performance level actually triggers them. No guesswork.
So it's all laid out clearly from the start.
That's the commitment. Faida Ventures, for instance, specifically mentions providing clear reporting and performance summaries. That visibility is essential for trust.
And they explicitly say no platform fees, no inactivity charges, none of those weird, vague costs.
Correct. The idea is to strip away all those ambiguous charges. It's meant to be a straightforward deal. You pay a share of the profits when there are profits above the high water mark.
Mm-hmm.
That's it.
It's like knowing the final price. No hidden extras at the till. That alone must boost confidence quite a bit.
Absolutely. When you're not constantly wondering if there's some hidden cost eating into your money, you can focus on what matters, the actual investment performance.
Makes sense. Now, something you touched on earlier, access. I always thought profit sharing, this kind of performance fee structure, was mainly for, like, hedge funds.
Yeah.
You know, big money institutional clients.
Historically, yeah, that's largely been true. The source material points it out. It was often restricted to high net worth individuals, private equity, that sort of thing.
So what's changed? Why are we talking about it now in a way that might apply to, well, more average investors?
Technology. It really boils down to advancements in technology, fintech, automation. It's broken down a lot of those old barriers. It's made it possible to offer these more complex but potentially fairer models to a much wider audience, including retail investors.
Wait, so you're saying someone with a regular brokerage account, not millions of dollars, might actually be able to access a managed account that uses this kind of profit-sharing model now?
That's exactly the shift that's happening. The source highlights this democratization, giving, quote, everyday traders the same opportunities as institutional clients. Think about it. Smaller account holders getting access to potentially sophisticated strategies, maybe automated systems, and that ethical alignment we've been discussing.
Wow. Okay, that is a big deal. It's like lowering the drawbridge on the castle, letting more people in.
It really is. It's breaking down those walls, those high minimums and complex structures that kept most people out of these kinds of performance-aligned arrangements before.
That feels potentially quite significant, leveling the playing field somewhat, giving more people access to structures where the manager is genuinely incentivized for their success.
That's the core idea. Empowering more investors by making these models, these potentially more advantageous setups, available and understandable.
Okay, let's try and pull this all together then. We've talked about how these transparent profit-sharing models really align interests, manager and investor pulling in the same direction towards profit. We saw how the high watermark acts as that crucial fairness mechanism, ensuring fees only apply to new games.
Right, protecting the investor.
Then there's the clarity, getting rid of hidden fees, building trust through transparency.
Super important.
And finally, this exciting shift towards accessibility, opening these models up beyond just the ultra-wealthy to potentially benefit everyday retail investors.
Yeah, democratization through tech.
It really does sound like what the source calls a philosophy of fairness and a commitment to shared success. It's a different mindset.
It is. And for you, listening, trying to make sense of the financial world, hopefully understanding these structures helps build confidence, knowing how fees work, when they apply, and that they're tied directly to positive results for you. That clarity can make a real difference in trusting who manages your money.
Absolutely. So maybe a final thought to leave you with, something to chew on. Think about other services you use, not just finance. Where else could these core ideas, alignment, transparency, shared success be applied? How could that change things? What does a truly fair, truly ethical exchange look like in any relationship where you rely on someone else's expertise or service? It's definitely something worth pondering.